had the chance to sit down with Bob Sulentic, the Chief Executive Officer of the CBRE Group. That's the world's largest commercial real estate services and investment firm. And despite all the headlines around WeWork and talk about froth in the markets, he says commercial real estate is fundamentally healthy. Take a listen.
Occupancies across product types and around geographies are generally high. There's upward pressure on rental rates. There's not a lot of building coming online in most product types in most markets, which means there won't be overbuilding. There's capital available to acquire buildings to the extent owners of buildings want to sell them. So in general, when we talk about the fundamentals of commercial real estate, the fundamentals of commercial real estate are strong right now.
And we've seen a number of banks and investment firms move some of their staff elsewhere outside of some of the coastal regions because they are getting expensive. And I'm wondering, Goldman Sachs' merchant bank actually is buying in non-coastal areas. Do you also see that as a potential opportunity?
Well, we call that the move from gateway markets to secondary or tertiary markets. It's something that's been observable for the last few years, and what's driving that in part is the gateway markets have gotten expensive. Property in the gateway markets has gotten expensive. Labor in the gateway markets has gotten expensive. On the flip side, you're seeing technology start to move to these second-tier markets. So like Tampa, Florida, like Pittsburgh, Pennsylvania, like Denver, Colorado. You're seeing an influx of tech workers, which makes the buildings fill up, rental rates go up, and that becomes more attractive to capital. And capital can generally make slightly better, if not sometimes quite a bit better deals in those markets. That's really what you're seeing there.
Blackstone's highest conviction bet right now is warehouses. Do you agree?
Warehouses have been tremendous for some time, and they continue to be tremendous. Again, the fundamentals are strong. So the buildings are generally full. Rental rates are strong and going up. There's real interest from the e-commerce companies in using warehouses to store and then distribute their product. There's a lot of good things going on in that market, and it's not surprising to see a smart investor like Blackstone concluding that's a good place to be.
As a developer and a financer and an investor, how worried are you about WeWork and what we saw there, especially as they post a much bigger than expected loss and continue to bleed cash?
Yeah. So the WeWork story is the most famous thing going on in real estate today, certainly in the big markets around the United States and places like London. We have studied co-working very closely, and WeWorking was a co-working company. There is a fundamental thing going on in co-working that's independent of WeWork. We believe that today around 2% of the multi-tenant office space around the world is in co-working. We think over the next several years that could go to as much as 10%. What's driving that is that occupiers want a sliver of their space. Big companies want a sliver of their space in a more flexible type use, and co-working solves that problem. There's a little bit of a misperception. WeWork was doing a lot of leasing in New York and London and some other markets, but we're the biggest leasing company in the world. And over the last year, co-working in total, not just WeWork, co-working in total has made up about 4% of our leasing volume. In the last quarter, 3%. So I think that story got a little bit overtold for a bunch of reasons.
So Brookfield recently came out and said that they still are interested in malls, even though that is going against the tide somewhat. Is that also a space that you're interested in, given some of the depressed nature and the valuations there?
Yeah. We watch retail very closely. And again, I think there's a headline story that there's some merit to, but there's an underlying story that's a little different. So the fact of the matter is that about 85+% of the things that can get sold through brick and mortar are still being sold through brick and mortar today. Now, that means not 100%, right? It's come down from 100%. But there is still a real demand for brick and mortar space.
So CalSTR's Chief Investment Officer, Chris Ailman, was on this show a couple weeks back, and he said that he sees the commercial real estate market as incredibly frothy, in particular in a lot of the large cities, and he's collecting cash to sort of pounce when he sees better opportunities. Are you also seeing opportunities to build cash, to sell, to be a net seller and prepare for a downturn?
Well, we have a real estate investment management business that's raised billions of dollars this year, so we do have plenty of what we call dry powder. I also think the opportunity around office space is a little underestimated. One of the things that you've seen in our sector over the last year and a half is a tremendous amount of leasing. Part of that is from job growth, but part of that leasing is coming from companies that want to use office space to attract, retain, motivate their employee base, make that employee base more productive, and they're restructuring the way office space is designed and built.